of markets tomorrow for you. We've got Peter Elston. He represents Aberdeen AMC along with Nipun Mehta, founder and chief executive officer of Blue Ocean Capital. And then to give us a technical picture, it's all about Sandeep Wagle. He represents Apata Technical Advisory Services. Net. Benchmark indices were rusty, but mid-cap stocks, they continue to outperform, and I think that's important for us to differentiate that it's all about stock-specific action. It's all about picking up the right stocks in the current environment. Do not bet on the haystack, which is ignore the Sensex and ignore the Nifty. Sandeep Wagle, would you agree with my assessment?
Yes, Nikunj, you said it all. The Nifty is very range bound, 5600 on the downside, not willing to break that. The bulls are not willing to let go. And 5680, 5690 on the upside is acting as a strong resistance. Probably there is no trigger. There is more trigger for stock specific action as is seen. And I fully agree with whatever you said. I think the next few days or possibly few weeks is going to be the mid-cap story and stock specific action. And Nifty is likely to continue in this sideways band for the next probably a week or two.
Sandeep Wagle, I would ask you a tough question. And the question is, do you think Indian markets will break the jinx of 5800 before the year end?
Frankly, I don't think, Nikunj. I think they'll be range bound. They'll not break 5800, but the good news is that they'll not break 5600 either. So this 150, 200, 180 point range is what the Nifty is likely to be. And normally in the month of December you have a lot of holidays. So I really don't think it will be a one-way move as far as the Nifty is concerned. But stock specific, you will get good moves, and specifically in some select mid-caps and some select sectors, talk of pharma and what we have been seeing. So there will be some other sectors and stocks which will move. But as the Nifty, if somebody is a trader in the Nifty, I think he'll be in for a big disappointment.
Let me also encourage Nipun Mehta to join in. Nipun, good evening to you. Thank you for joining us. Nipun, what is how would you characterize the market environment? What is your assessment? Is it time to put money to work, or investors, they should exercise some patience because this market could give better and lower entry points as the year unwinds?
Well, good evening, Nikunj. I think what you're seeing in the market is, if you analyze over the last few months really, not just a few trading sessions, is that there has been a significant run-up as far as a lot of mid-cap stocks are concerned. The index might not have moved too much, it might have been range bound, but very clearly you're seeing significant gains as far as mid-caps are concerned, based on actual results, based on fundamentals, and based on a lot of top-line growth that you've seen for a lot of these companies, particularly FMCG, pharma, cement, some of the private sector banks and all of that. I think that's something that will continue. You might not see an overall significant rise as far as the market is concerned, but the rise in individual mid-caps is something that will continue. So when you're looking at investing, I think if you're looking at a relatively diversified portfolio, it is a good time to start taking positions in the market in some of these mid-cap stocks rather than sitting on the sidelines. You might see a very range-bound market happening maybe for another month or two, maybe till there are fresh FI allocations that start in January. So you could see that range-bound market or low volumes in a lot of these mid-cap stocks. So, but that doesn't mean there isn't an opportunity. I think rather than sitting on the sidelines, it's great. It's an opportunity to start looking at markets and looking at the possibility that there could be a good budget which could ensure that there is a market rally. Look at the possibility that there could be further reforms coming in post the parliament session, right, and that could result in a degree of rally as far as the markets are concerned. So I think it's time to take small bets into mid-caps.
Right. Fair point. Pharma stocks today selectively were in demand. Glaxo Pharma went up because there's an open offer which the parent has triggered in Glaxo Consumer. Stride, there is a buzz that they're looking at selling the injectable business very soon. Wockhardt, of late brokerages have upgraded their price target for Wockhardt. And if I map Claris, there is a buzz that Claris also is looking at selling their injectable business to a Japanese firm. Peter, as a house, what are your thoughts on pharma? Because if I look at your declared portfolio, pharma is one space where you have very little exposure.
Oh, well, Indian pharmaceutical companies, it's in some respects, it's a little bit like the IT companies. I mean, these are companies which have an extremely strong competitive advantage relative to global players. You need you know, a lot of expertise, and a lot of the global players are actually stepping back from pharmaceutical research, and that's opening up an opportunity for these Indian companies in many ways. So it is a very interesting sector. It's one where you know, India does have an extremely strong competitive advantage. So absolutely, we see an interesting opportunity there.
All right, let's take a break. But before that, here are some F&O ideas for you for tomorrow morning from CK Narayan.
One is Dish TV, currently trading at about 78 in current month and a little higher in the next month. So I would be comfortable buying December futures if there were to be a pullback near about 76, 76.5. Similar is the situation for the second recommendation, which is Titan. Currently around 303.4 in November series. Look to buy December series on a pullback to somewhere near 300 rupees. The market has been on a slight bit of runaway. Day after tomorrow is a holiday. The expiry date is looming ahead of us, so I don't really want to get charged up and buy at the higher levels where we may have some profit-taking pullbacks tomorrow. So wait for a pullback and buy these two. Keep about 1.5% as the stop loss from your entry price and about 2 to 3% as the target prices.
Nipun, to your mind, what is driving airline stroke aviation stocks? Hope, hot air, or short covering?
Well, I think it's a bit of both, but I think that this is very clearly only a trading opportunity. As and when the stake is taken, depending on what price the stakes actually get sold, if they actually get sold, that will be the probably the end of how much the rally will, how much the stocks will rally. Really, this business isn't a profitable business globally. It's just because a foreign airline takes a stake, and there are several such alliances that are there in terms of cross-shareholding that are there. That doesn't really make an airline profitable. So the rise very clearly is on the basis of these stake sales, and as and when and at what price the stake sales happen, you could see a topping out of this kind of a price movement. Till then, probably it's a trader's paradise, or in terms of the volatility that will be there.
Sandeep Agle, do you think SpiceJet soon could be a 50 rupee stock?
Nikunj, can be, but if you ask me whether I'll buy it at this level, I'll say no, because the financials will not match, and the news, if there is something negative, it can fall also that way. I'm not suggesting that there is anything negative on the charts, because the charts are still looking positive. But if you are already bought in at lower levels, you can hold on for a bigger move with a trailing stop loss. You can't buy it at this level, whether be it a jet or a SpiceJet.
Peter, since I know the answer, I will not ask you a question on aviation, but I'm curious to understand that why of late, as a house, you have reduced your exposure to Bharti.
Well, Bharti has been a stock that, yes, has not performed well in recent years. As we all know, the telecom sector has been plagued by all sorts of things, whether that's competition, whether it's issues on the regulatory side, and we have exited Bharti from our emerging markets fund. We remain invested in Bharti in our India fund, so it's not as if we've turned negative on the stock. The fact is that for our emerging market fund, the bar that these companies have to hurdle in order to qualify for investment is extremely high. Our emerging market fund is investing all around the world. We have a relatively concentrated portfolio of around 50 to 60 names. So, for a company to get into that portfolio, it has to be extremely high quality. And I think what we felt is, in the case of Bharti, that because of the issues in the sector, it doesn't quite, make the grade for that fund, but it does still make the grade for our India fund, and we're sticking with it. In terms of the timing, it may not have been exactly the right time to get out of the stock, but then you can never get your timing absolutely perfect.
Sandeep, if I map the market into two, traders are clearly focusing on media, real estate, and aviation stocks. But if I look at the broader plank, which is IT stocks are also making a base. It was a good Friday for large cap IT stocks, and today also IT stocks in an otherwise very ordinary market, they have been marked outperformers.
Absolutely right, Nikunj. In fact, Wipro and Infosys has been moving up for the last 3 or 4 trading sessions, and it has moved up well and suggests some more upside. Wipro has given a breakout today, suggests a move till possibly 390 or so. So 4, 5, 6% trading upside in the most of these IT stocks. I would go with it.
Peter, as a house, Aberdeen has a large exposure to both Infosys and TCS. But given the way how TCS has disappointed and Infosys has disappointed and TCS has surprised, are you now seriously looking at increasing your exposure to TCS and reducing your exposure to Infosys?
Yeah, TCS and Infosys have slightly different business models, and for that reason, they tend to have over short-term periods they can perform quite differently. But if you look overall at their numbers, returns on capital, returns on equity, debt to equity ratios, they're all very good indeed, and they both have very strong balance sheets, net cash positions, returns on capital in the 20 to 25% level. And the fact remains that this is a sector in which Indian companies have an extremely strong competitive advantage, which isn't going away. They are certainly beneficiaries of the weakness that we've seen in the rupee this year. So certainly a sector where we're long-term holders.